Investors, especially in the U.S., will be watching the Fed minutes set to be released at 2 p.m. local time on Thursday. For insight now on what to look for, we are joined on set by Eran Peleg of Clarity Capital. Thank you very much for being with us today.
Pleasure to be here.
Well, given all the weakness that we've seen with the economy and the turbulence in the markets and all these recent Fed statements, what can we expect today?
So, I think that the Fed has their upcoming meeting towards the end of October. That's what people are really going to be looking for at the moment, or looking at. And I think that most likely that given the weak data, but also the general economic conditions, which are, growth has improved in the U.S. in recent years, but it's still fairly moderate. Inflation is still very low. The preferred inflation measure that the Fed looks at, which is called the core PCE, is only up 1.3% year on year. That's much below the Fed's target, which is 2%. I think that the Fed can wait and with interest rate increases. The market, I think, is pretty much in agreement with that view now. When we look at the futures contracts, for example, at the moment factoring in less than a 10% probability that the Fed will raise rates at the end of October. Next meeting, December, the probabilities are probably higher. The market is saying somewhere around maybe 37% at the moment. All in all, we're coming from a place where several months ago, earlier in the year, people saw this thing, the start of the rate hike cycle in the U.S. as a highly probable thing this year, and the Fed actually said that they will raise rates in 2015. At the moment now, the market's giving it less than a 50% chance for 2015.
And is this mostly because of the turbulence that we saw in the Chinese markets? Was that the big swing here in sentiment?
So, that's kind of, obviously that was very important. China is an important economy today. The growth momentum there has slowed considerably over the last couple of years. Just, 4 or 5 years ago, China was growing at 10, 11, 12%, and now it's slowed down to 6, 7%. It's not just China. There's weakness in the entire kind of emerging markets complex driven by China, and the concern is that is obviously dragging down global growth. But
we still saw positive reports coming from the IMF about the Western Hemisphere and the growth there in these developed countries. So why is there so much emphasis here on the emerging markets?
So it's true. That the IMF just earlier this week have updated their forecast. They did downgrade global growth somewhat from 3.3% to 3.1% for 2015, and also 2016 from 3.8 to 3.6, if I'm not mistaken. It's really been dragged down by emerging markets. As you say, developed markets seem reasonably stable, but there are, you have to watch to see if there's any spillover effect. And we've seen, for example, even, we've seen the jobs report in the U.S. on Friday. That was much weaker than expected. So I think the Fed and the market is still monitoring the economic data for signs that, to see whether there's a spillover from emerging markets to developed markets.
Right, that is an important factor here. When do you expect, though, this rate hike to actually occur? In 2016, early 2016?
I would say most likely in the first quarter of 2016. No, I can't rule out December. I don't think October will happen. December is possible, but I would say most likely in 2016. I think the Fed wants to start moving rates higher. It's a matter of, first of all, it's a matter of credibility as well. As I said before, they've been talking about it for so long. They kind of want to, be seen as keeping their word. Also, the uncertainty around U.S. monetary policy is actually a factor of risk within markets at the moment. And if what they're looking for, to some extent, is also, to stabilize things after some of the turmoil that we've seen, driven by China and emerging markets and so forth, removing an uncertainty factor from the market might be a good thing. And U.S. monetary policy at the moment, the market has no clarity whatsoever on what is the Fed's intention, what is the direction of monetary policy. So I think that in itself is causing a lot of uncertainty, and just maybe removing that,
might stabilize the markets further.
It might actually stabilize the market to some extent.
Thank you so much for being with us today. Very much appreciate your insight.